Hello, everyone. Welcome to One on One with the Prophet. I am Victor Durganov, the Financial Prophet, and welcome to this week's Prophet Report. So, last week we discussed how no one really wins in a trade war. Nonetheless, U.S. tariffs may boost domestic production and employment with minimal long-term negative impacts on the U.S. economy, while Canada and Mexico may face potential recessions. Now, tariffs, we also discussed how tariffs serve as an effective negotiating tactic, potentially leading to more balanced global trade dynamics and benefiting U.S. small and mid-cap companies, which could also improve the U.S. labor market and basically boost the United States GDP. However, in order for these tariffs to be effective as a negotiating tactic, they have to be implemented in some form, which is what I believe President Trump is doing with these initial Canada and Mexico and China tariffs. And Donald Trump has agreed to hold off imposing the 25% tariffs on Canada and Mexico for 30 days, pulling the North American neighbors back from the brink of a potential damaging trade war, BBC reports. Now, after last-minute calls with Trump, Canadian Prime Minister Justin Trudeau agreed to reinforce his country's border with the U.S. to clamp down on migration and flow of the deadly drug fentanyl. Now, we also know that the Mexican president has promised to put 10,000 troops on the Mexican border permanently to also prevent illegal migrants from crossing over into the U.S. and to prevent the flow of fentanyl through. He says that earlier, Trump made a deal with Mexican President Claudia Sheinbaum. She agreed to reinforce the northern border with troops, and in return, the U.S. would limit the flow of guns into Mexico. So clearly, we see that the tariffs are having an effect, and they are working. Now, we also saw that the market became quite volatile around this time when the tariff talk came out. But we've seen the market calm down a bit since then. But now we see the market basically focusing more on potential tariffs with Europe. So in this week's article, I'm addressing this topic more. So I titled this article, "Don't Panic, There May Not Be a Trade War." Now, just some bullet points in this article are that the U.S. has significant leverage in trade disputes with the EU due to it. I'm also discussing broad economic topics in this article. So lower than expected inflation could lead to more aggressive rate cuts by the FOMC, which could boost stocks and other risk assets. Now, also, despite market volatility, strong earnings, reasonable PE ratios, and AI investment growth suggest a bullish outlook for U.S. stocks. So I maintain my 7,000 S&P 500 target for year end. Now let's talk about the potential trade war with Europe. So the focus has clearly turned to the EU. Now, the US and the EU may be the two most significant economies globally. However, despite having a population of roughly 400 million people, about 35% more than the US, the EU's GDP was around $18.5 trillion in 2024 versus the US's $29 trillion. Now, don't get me wrong, while I am an American, I like Europe very much. I even live in Europe. I live in Greece. However, Europe does have more to lose than the US in a trade war. While some Western European countries want some things, certain Eastern European and Southern countries may want other things. Now, basically, last year, the U.S. imported about $606 billion worth of goods from the EU, while the EU imported only about $370 billion worth. So there's a massive $235.5 billion trade deficit with the EU. Now, this is not just a one-off year or something. This is an ongoing situation. For instance, in 2023, the trade deficit was about 209 billion. In 2022, it was 203 billion. In 2021, it was 218 billion. So we see that this is an ongoing, basically, this is an ongoing topic where there's a huge trade imbalance with the EU. Now, this dynamic basically illustrates that the U.S. imported almost twice as many goods as it exported. Now, the unfair factor here is that while the U.S. charges a very small 2.5% tariff on European cars, the EU charges a very high 10% tariff on on American cars. And this has been an ongoing issue, and there are already talks about possible concessions being made by the European Union. Basically, the European Union is preparing to offer reduced car import tariffs to the United States as part of negotiations aimed at preventing a potential trade war with Donald Trump. So, I mean, we see that just the threat of an escalation of I guess a trade war, you can call it. It's already causing the EU to look to make concessions, because it's really not fair what's happening. And I was in Berlin last week, and I saw very very few American cars, to be honest with you. Maybe just an occasional Ford like utility van here and there, but it's just basically German and Japanese cars and Korean cars for the most part. But very very few American cars in Germany and in other European countries as well, excluding Tesla, of course. I saw plenty of Teslas in Germany. Now, there's obviously good reason for this. Who in Germany would want to buy a regular GM or a Ford after the EU slaps a 10% tariff on U.S. cars? It just makes very little sense for for Europeans to buy American cars. Um, so, I mean, what happened to fair is fair. So basically, the U.S. makes it inexpensive and easy for many EU products to come in and to be sold in the U.S., while the European Union makes it considerably more expensive and more challenging in many cases for some U.S. products to come in to the European market, which is partially why we see such a massive imbalance in trade. So the trade dispute and future negotiations are necessary. While these trade developments may lead to transitory near-term volatility increases, they should have a net positive intermediate and longer-term effect, especially for the U.S. economy and top-performing high-quality U.S. companies, in my view. Now, we already witnessed progress regarding Canada and Mexican trade developments, as we just discussed. The concessions being made, more people, more troops being sent to the borders, a lot more being done basically to avoid a trade conflict with the U.S. And let's just look at these statistics here, so we can better understand why other countries want to avoid a trade conflict with the United States. So, I mean, looking at the statistics here, the United States had a GDP of over 29 trillion last year, which is massive considering that China, basically the next closest economy, was around 18 trillion, and Germany, the third most significant economy's GDP was 4.7 trillion. Now, if we look at this from like a trade, negotiating perspective, the U.S. economy just expanded to over 29 trillion dollars, which is more than the next several economies combined. Now, the U.S. economy is considerably bigger than China's economy, as we discussed. Now, but despite having far fewer people, it's bigger. So it only has about 24% of the population, yet the economy is significantly more substantial. Now, as far as Europe is concerned, the most powerful and productive and influential economy in Europe is Germany, which has a GDP of 4.7 trillion in 2024, which is roughly 16% of the US's GDP. Yet Germany's population is about 25% of the US. So what that's telling you is that despite, Germany's economy being powerful, productive, efficient, and influential especially within the European sphere, it's still America's economy is still substantially, of course, larger, but it's also more productive and efficient and more dynamic than the German economy. Now, if we look at France, France is Europe's second most significant economy. It has about 10% of the United States GDP, yet its population is about 20% of the US. So, I mean, you can look at this as basically potentially the US being twice as productive as France, just from like a pure economics perspective. So, I mean, now if we look at Spain, Spain has a GDP of about 6% relative to the US, yet the population is almost 15%. So this is showing us that Spain's economy. It's even less efficient, less productive. So I guess I'm not trying to speak poorly of European economies. It's just that The European economic system is much different from the United States economic system. The U.S. is the most dynamic and the most powerful and the most cohesive economy globally. The EU, on the other hand, has several very different economies in incorporated in a single union. However, um, the independent countries are much more dependent on the U.S. for trade for their exports to be imported into the U.S. and basically sold in the U.S. market. This is very important, very crucial for many European economies just to basically remain afloat and not go into recessions. Therefore, there's a very high probability that the EU will do will be willing to perhaps negotiate and reevaluate some of the trade agreements to make them fairer, to make them less one-sided towards European interests, and this will be to avoid tariffs on European goods, which if they do occur, it could push European economies into recessions, which is why I believe that there really shouldn't be any kind of panic about a potential trade war, and really there's a high probability that a trade war can be averted here, in my view. Now, let's move away from the trade tariffs a little bit and the trade talks, and look at some other critical information. So we have critical inflation data this week. We have the CPI and the PPI, but the CPI, the consumer price index, is more important. Now, the CPI inflation is a potential market moving event. The market expects the inflation gauge to be around 2.9%. Now, if the CPI comes in higher than expected, around 3%, it would be very negative. However, I believe this is a low probability event. Now, if the CPI comes in around 2.9%, it may get a neutral to a slightly negative knee-jerk market reaction, but it shouldn't be too bad for stocks. However, now, if the CPI comes in around 2.7 or 2.8, it could be very positive for stocks and other risk assets, as it would show inflation basically coming down more than anticipated. And I believe that the highest probability is that we could see a 2.8 print on Wednesday. Now, why inflation may be lower than expected is basically we saw a big inflation, a big transitory inflation uptick after the massive inflation drop from the 11% or so. If you're looking at truflation, or at around 9 to 10% or so, if you're looking at the CPI, and inflation crashed all the way down to 1 or 2% if you're looking at truflation, or 2 to 3% if you're looking at the CPI or the PCE. So we saw a transitory uptick, but recently we saw truflation basically drop back down to 2%, which suggests that the recent inflation uptick may have been transitory after all, like I've been saying for a long time. Now, truflation is more of a leading indicator relative to the lagging CPI and PCE gauges, and it could prelude lower readings in the CPI, PPI, and the PCE, which is one of the reasons why I believe we could see a lower CPI and PPI print in the upcoming session. Now, this dynamic may be bullish, as it could lead to lower than expected inflation, and the FOMC may need to cut more than anticipated and quicker than recently discussed by Fed Chair Powell. Now, let's look at the FOMC rate cut expectations here, and we see that with inflation potentially declining more than expected, the FOMC may cut rates more than anticipated this year. So the market is really only pricing in 1 or 2 25 basis point cuts this year. So the CME Group's FedWatch tool illustrates there's about a 54% probability that the benchmark will remain unchanged, or be just 25 basis points lower by the end of 2025. Now, there's only about a 46% probability that the benchmark will be lower by 50 basis points or more by the end of the year. So, I mean, the market expectations are very hawkish here, basically. This dynamic suggests that the market may be too bearish and the Fed may be too hawkish on rate cuts. Therefore, we could see rate cut probabilities increasing as inflation continues moderating, which should be a constructive factor for stocks and other risk assets. Now, we also just witnessed another solid earnings season with 75% of companies beating their estimates. So that is another big plus here. People often say that the PE ratios are really high, and that they're very skeptical on stocks here because they're afraid that the PE ratios basically are around peak levels, which is unlikely in my view. So if we look at the Russell 2000, basically it's only trading at a PE ratio of around 25. So despite talk about extended PE multiples, many stocks are actually inexpensive now. For instance, the forward P ratio for the Russell 2000 is below 25, which is inexpensive considering the potential future benefits for small and mid-cap stocks. Uh, these small and mid-cap companies could benefit much more from a lower interest rate policy, which is why a 25 forward P is quite low. Now, if we look at the forward P ratio for the Nasdaq 100, it's below 28, which is also relatively inexpensive in my view. Now, we should also consider that the big tech mega caps have relatively high PE ratios. So there are actually many stocks in the Nasdaq 100 and in the S&P 500, basically below the surface, that are trading at 15, 12 forward Ps or lower. So now, even at around a 22 forward PE ratio, the S&P 500 also seems relatively inexpensive given the financial dynamic and the growth outlook. So we can also look at the S&P 500 equal weighted P ratio, which is only about 19 here. Now, this dynamic shows that if we exclude the highly valued mega cap tech stocks and other specific stocks, many smaller and under the radar stocks in the S&P 500 and in the Nasdaq 100 actually appear cheap now. It's also crucial to consider that we remain in an easing monetary environment with fiscal stimuli and other positive catalysts ahead. Furthermore, the AI gold rush is not over. On the contrary, the multi-billion-dollar AI budgets for 2025 show no signs of slowing in AI investment spending, suggesting the potential for more significant and sustainable AI growth ahead. And we just saw massive announcements from Amazon, from Google, from Meta Platforms, and other companies about huge AI spending programs. Now, while the current economic environment supports moderate valuations, we could see a powerful combination of higher earnings growth coupled with multiple expansion, leading to even higher valuations as we move ahead. Now, I also want to underscore that despite the possibility for more near-term volatility, the intermediate and longer-term economic dynamic remains constructive, and the setup for risk assets is bullish here in my view. Therefore, I'm keeping my year-end S&P 500 target at 7,000. Now, that's my report on tariffs and the markets in general this week. While there may be some more transitory volatility ahead, I expect another solid year in 2025. I want to also thank you for watching my profit report. If you enjoyed my video, please click like, press that subscribe button to see more of my videos, and you can also follow me, Victor Durganov, the Financial Prophet, at seekingalpha.com. Thank you very much for watching my video. Have a wonderful day. Goodbye.